Welcome to Dollar Roots. Today we re-diving deep into a real-life story that feels more like a Hollywood script than a finance lesson. It's about how one Nobel Prize-winning economist, Dr. Richard Thaler, used a genius money hack to outsmart the entire stock market. And the best part? I'm going to show you how you can learn from his playbook to make smarter decisions with your own money. So grab a coffee, get comfortable, and let's unravel this incredible story. Dr. Richard Thaler wasn't your typical economist, staring at charts and crunching numbers all day. He revolutionized the field by blending economics with psychology, creating what we now call behavioral economics. While traditional economists assume people always make rational, logical decisions with their money, Thaler looked at the real world and said, "Wait a minute, that's not how people actually behave." He proved that our decisions are often driven by emotions, biases, and mental shortcuts, especially when it comes to investing. Think about it. We've all felt that knot in our stomach when we see our investments drop. That's fear. Yeah. Or that rush of excitement when a stock is soaring. That's greed. Thaler dedicated his career to studying these very human impulses. He realized that fear and greed, not pure logic, are the real forces that move markets. This fundamental insight wasn't just an academic theory. It became the key to unlocking a powerful investment strategy that turned conventional wisdom completely on its head. One of his most eye-opening insights was about how investors react to market volatility. Picture this. The stock market takes a sudden nosedive. What does the average person do? They panic. They see red on their screen and their first instinct is to sell to stop the bleeding. They act on raw emotion, trying to cut their losses. But in doing so, they often lock in those losses and miss out on the eventual recovery. Dr. Thaler saw this widespread panic not as a disaster, but as a massive opportunity. His genius was to flip this emotional reaction around. Instead of running from the fire like everyone else, he understood that the best time to buy is when fear is at its absolute peak. Think of the market like a roller coaster. Most people scream and hold on for dear life during the drops, feeling nothing but terror. But if you think about it, the dip is what sets up the thrilling climb back up. Thaler's strategy was to remain calm during those terrifying moments. Recognize that the fear was temporary and use it as a signal to buy quality assets at a huge discount. He knew that markets historically always recover. So, while everyone else was selling low in a panic, he was calmly buying low, positioning himself perfectly for the inevitable bounce back. It's a classic case of being greedy when others are fearful, and it's a strategy that has made legends like Warren Buffett billionaires. Let's look at a concrete example. The 2008 financial crisis. People were pulling their money out of the market as fast as they could. The headlines were screaming financial apocalypse. It felt like the end of the world. An emotional investor would have sold everything. But a behavioral economist like Thaler would have seen this as the sale of a lifetime. Stocks of fundamentally strong companies were trading for pennies on the dollar simply because of mass hysteria. Those who had the courage and the discipline to buy during that period of extreme fear saw their investments multiply many times over in the following years. This isn't just about timing the market, it's about timing human emotion. Here's a crazy fact that really drives this point home. Multiple studies, including groundbreaking work from firms like Thaler, have consistently found that emotional trading, buying high out of FOMO and selling low out of panic, costs the average investor dearly. We're talking about a performance gap that can shave off anywhere from 2% to as much as 10% in potential annual returns, compared to just holding a simple index fund. By understanding the psychological traps that cause these losses, Dr. Thaler essentially created an antidote. He turned this common human weakness into his greatest money-making edge. He wasn't just a better stock picker, he was a better psychologist of market behavior. So how did he put this into practice? Thaler co-founded a money management firm called Fuller and Thaler Asset Management. Their entire investment philosophy is built on this principle. They actively look for stocks that have been beaten down due to what they identify as an emotional overreaction from the market. For instance, if a solid company misses its quarterly earnings by a small margin and its stock price plummets by 30%, that's a signal for them. They analyze if the market's reaction is justified by the fundamentals. More often than not, it isn't. The panic is exaggerated, so they buy the stock, betting that once the dust settles and logic returns, the price will recover to its true value. It's a strategy of betting against the crowd, as short-term panic and reaping the long-term rewards when calm and reason prevail. Let's break this down into a practical takeaway for you. You don't need a Ph.D. in economics to apply this principle. Starts with self-awareness. The next time you see the market dipping and feel that urge to hit the sell button, pause. Take a breath and ask yourself, am I reacting based on logic or fear? Remind yourself that market downturns are a normal, healthy part of investing. They are not the exception. They are the rule. Instead of viewing them as a crisis, start viewing them as a potential buying opportunity, a discount sale on your favorite assets. Here's a simple action plan. First, have a long-term investment plan and stick to it. Knowing your goals helps you ride out the short-term storms. Second, consider a strategy called dollar cost averaging. This means you invest a fixed amount of money at regular intervals, regardless of what the market is doing. When prices are low, your fixed investment buys more shares. When prices are high, it buys fewer. This automatically forces you to buy more when things are cheap, taking the emotion out of the equation. It's Thaler's philosophy on autopilot. By understanding the very predictable ways people make mistakes with money, Dr. Thaler didn't just win a Nobel Prize. He created a practical and powerful workaround for building wealth. It's not about finding a secret stock or a complex algorithm. It's about understanding human nature and then doing the opposite of what your panicked instincts are telling you to do. The next time you feel the market's heat and the urge to panic sell, remember the lesson from Dr. Richard Thaler. The smartest money in the room knows that the best time to invest is when everyone else is scared. Master your emotions, and you'll be well on your way to mastering the market. If you found this story as fascinating as I did and want more insider stories from the world of finance, make sure to hit that like button, share this video with a friend who might need to hear it, and subscribe to Dollar Roots for more content just like this. Stay curious and stay wealthy. Thanks for watching.